Hello, my name is DBarbier, and this is my Bloomberg analysis project for Finance 451. The goals for this analysis is to analyze 5 different companies across 2 different industries, pick the best company from each industry, and then pick the best company overall. I chose 2 different industries to analyze, the fast food industry and the technology industry. For fast food, I chose Popeyes, McDonald's, Sonic, Wendy's, and Jack in the Box. And then for the technology industry, I chose Apple, Amazon, Garmin, IBM, and Microsoft. The criteria I used for this analysis was a series of ratios. I got some short-term solvency ratios collected, long-term solvency, asset management, profitability, and market value ratios. First, we're going to start with the fast food industry. Starting off, we're going to look at the current ratio. If you notice, Wendy's is at the top, declines, and then starts inclining right here. McDonald's has a steady incline, and then from 2014 they inclined a lot. This ratio shows the company's current assets to current liabilities, and McDonald's is on the rise. If you notice, Sonic goes up but is decreasing, and it looks like they're going to stay decreasing, and then Popeyes and Jack in the Box are kind of just skating around at the bottom. If you notice this graph, it's very similar to the current ratio graph. We're looking at the same trends here. It's the quick ratio is the same, except we're subtracting inventory from the numerator, so it's going to be kind of the same. As you can see, the graph looks very similar. Cash ratio, the same thing. This ratio is showing how liquid these companies are because they have a lot of cash to liabilities. I like McDonald's in the short term because they seem to be on the rise at a fast pace. Next, we're going to look at the equity multiplier. This is a ratio of their assets to equity. All 5 companies kind of do the same little dip and then increase. Sonic is at the top of the graph. So this shows that they have a lot of assets to equity. Next, we're going to look at the time interest earned ratio. If you notice, Popeyes is inclining and stops very high on the graph. They're paying off too much debt too fast. Sometimes it's good to keep debt so they can use the money in other places to maximize shareholder wealth. These companies down here are doing fine. This is normal. This is Sonic and Wendy's. McDonald's is on a decline, so they're getting to a good spot, and then Jack in the Box is in the middle. The total asset turnover ratio is the sales to assets, so you kind of want this one to be a high ratio. Wendy's is below 1, McDonald's is below 1, Sonic is below 1, and Jack in the Box and Popeyes are higher up. Popeyes is on a decline and Jack in the Box is on an incline. This is a good ratio. You want this to be kind of high or higher. Now we're going to look at profit margin. I like how high McDonald's is. This is showing that they're getting the most income to their sales. Popeyes is close to them. They're both on the incline from 14 to 15. Right here, Sonic is showing to be on an incline. This is a good thing. They'll probably end up meeting these 2 companies eventually, and these 2 as well. Now we're looking at return on assets. I like Popeyes and McDonald's at the top, but they are declining, so they may end up where the other companies are, but I do like Jack in the Box and Sonic inclining to meet the companies at the top. Wendy's is pretty low, right here. Looks like they're almost a zero, and but they're steadily inclining too. Return on equities shows the returns from the shareholder earnings. Popeye starts off up here, which is like really high, and then they decline very, very fast. I like Sonic on this graph because they're steadily inclining at a fast pace. The other companies are kind of in the same area, and I like where these companies are. They're all on an incline, and I think they're all doing pretty good on return on equity. Looking at price earnings ratio, I like the lower ones on this graph because it's representing that they're earning more on the investment brought to the company. So every company besides Wendy's, pretty much, they're getting better. But I like the companies at the bottom on this graph. Now we're going to look at the market to book ratio. Look at Jack in the Box up here. I feel like Jack in the Box is way overpriced on the market. I don't think this is good for them. I think they're going to have harder times getting investors. I like McDonald's and Wendy's at the bottom, and also Popeyes, but I like the ones that are lower on this ratio. Here we're looking at economic value added. McDonald's is adding a lot of value to their company. Even though they're on the decline, they're still at a really high number, and I think they're going to do okay. All the other companies are normal. They're all at the bottom, but if you notice the huge difference between McDonald's and the other companies, just shows how much more successful McDonald's is in this industry. Same with enterprise value. All the other companies are just kind of skating along the bottom, and then McDonald's just has these really high numbers. They're very valuable. I think they're doing very good, and I chose McDonald's as the best company in this industry. I think after looking at all the information I collected and put into the graphs for the fast food industry, I like them the best. They have by far the highest EVA, and they dominate the cash, current, and quick ratios. Next, we're going to look at the technology industry. Starting off, looking at the current ratio, this ratio shows the company's current assets to current liabilities. Garmin and Microsoft are at the top of this one. This shows good for them. Apple is on a decline here. Looks like they're about to start going back up, and these companies are all kind of doing the same thing at the bottom, and these are doing the same thing at the top. Next, looking at quick ratio. As you remember from the fast food industry, the three short-term solvency ratios were all kind of the same. Nothing really changes much on these ratios, but each one tells you something a little bit different. This one's the same ratio, except we're subtracting inventory from the numerator, so it'll be pretty much the same thing. Now looking at the cash ratio, this shows liquidity. Microsoft is really high, so that's good. Garmin's high, they're declining. Apple is starting to incline here, and then they decline, they're starting to incline again. Amazon and IBM are kind of just skating along, but I don't like that these are below 1. I'd rather them be about 1 or higher. So for these short-term solvency ratios, I like Garmin and Microsoft. Now looking at the equity multiplier, this is a ratio of the company's assets to their equity. All 5 companies, as you notice, are on the same trend, with IBM at the top of the graph. IBM has the most leverage in this graph. Now looking at the times interest earn ratio, this shows if they can afford their debt. I don't like how Apple is declining very fast on here, and then the other companies are showing kind of the same numbers. They're doing kind of the same thing, and they're all kind of declining. But I don't like how Apple is declining so fast here. Here we look at the total asset turnover. Amazon is high, but it may be because they don't use that many assets because other people sell things on their websites. The other companies are kind of doing the same thing, same trend. You notice in all these graphs that within the industries, a lot of the companies have the same trends, which is something to take note of. Now looking at profit margin, the net income to sales, I like Apple because they're the highest ones and they're on an incline. Well, they're not the highest, but they're right below the highest one, but they're inclining the most. Garmin goes in incline and then declines. They're starting to incline again. Microsoft starts off at the top, and then they've just kind of been on a steady decline since then. Amazon's at the bottom. Now looking at return on assets, I like Apple at the very top. This is good for them. It means they're gaining a lot from their assets. I don't like how Amazon's at the bottom. These companies are all doing the same thing. They're all kind of sharing the same trend here. I like that IBM has a high ROE, earning more income from the money they get from shareholders. I think that's pretty good. Surprisingly, I thought Apple would be higher, but they're not. Microsoft seem to be doing pretty good, and then they're declining. And then all three of these companies are kind of going along, and they're inclining at the end. The PE ratio to me shows that Amazon is too expensive. These other ratios are going along the bottom at the same rate. They're all doing the same thing, but you notice that Amazon is just, something's going on here. I don't know why they're so expensive. Now looking at the market to book, this is also showing that Amazon is overpriced, so they're not getting as many investors. IBM is up here and then starts going down. These three companies are kind of going along the bottom at the same trend. Here at economic value added, Apple stays top. They have very high numbers up here. They're adding a lot of value to their company. Microsoft is kind of, I don't like this decline right here. IBM is kind of doing the same thing every year. Not much is changing. Garmin is on a straight line, and then Amazon is at the bottom at a negative number, which is not good. Here at enterprise value, it shows that Apple is the most valuable of all the companies. I don't like this drop right here, but it seems since 2013 they're inclining. I like Microsoft's steady incline here. IBM is declining steadily. Amazon is inclining, and Garmin stays at the bottom. In the technology industry, I chose Apple. I like Apple in this industry. I like their economic value added and their enterprise value, how it's also high. Out of all the 10 companies, I like Apple because I think they're most consistent overall. I noticed that the fast food companies experience the same negative trends in some years, representing that the fast food industry has experienced some issues within the past 5 years. All these numbers were collected from the Bloomberg lab at Southeastern, and thank you.